Hey traders, welcome back to the channel. I'm Lien, and I'm here to share some insights from my 20 years of trading that will hopefully make you a better trader. Now, if you're searching for a simple yet powerful trading strategy for Forex and indices, you're in the right place. Today, I'll share our 4-hour chart strategy that I use every day. This strategy employs one of my favorite indicators, moving averages. I know moving averages sounds simple, but trading really doesn't need to be complicated. I love moving averages for their versatility and their effectiveness. And effectiveness is key because if you want to be a successful trader, focus on finding the highest quality trades. And I hope the strategy will help you select the best ones. So whether you're a day trader aiming for high accuracy, small moves, or a swing trader targeting bigger gains, this strategy has you covered. Before we dive in, make sure that you hit the subscribe button and turn on the notifications so you don't miss any of our trading tips and strategies. Now let's get started. First, let's talk about why the 4-hour chart is excellent for both day traders and swing traders. For day traders, it helps capture small, accurate moves without the constant noise of shorter time frames. Swing traders, on the other hand, benefit from identifying bigger trends without having to monitor the market constantly. It's a perfect sweet spot for those looking to trade effectively with less screen time. Now, why moving averages? They're not just great for identifying support and resistance, but also for measuring momentum, which is crucial in trading. Moving averages, which basically measure the average price over a designated period of time, are a key component in many successful trading strategies, and I particularly love using them for their reliability and their clarity. This 4-hour chart strategy that we're going to talk about involves two moving averages, the 5 SMA simple moving average and the 50 SMA. Now, the 5 SMA moving average basically is a short-term moving average that dictates the market's short-term momentum, while the 50 SMA is a longer-term moving average that reflects the overall trend. So when the 5 SMA crosses above the 50 SMA, like you see in this dollar-yen chart, it means that the short-term trend has turned positive, and you should be looking for opportunities to go long. But there's a little wrinkle that I will share later. Meanwhile, when the 5 SMA crosses below the 50 SMA, as you can see in this euro-dollar chart, it means that the short-term trend has turned negative, and it's time to look for opportunities to go short. In this euro-dollar chart, you can see that the entry on the short was around 108, and the currency pair hit a low of 107.33, a nearly 70 pip profit on this short trade. As you can see, this is a simple yet effective crossover method that helps you identify potential trend changes and momentum shifts. This strategy works particularly well for euro-dollar, pound-dollar, and dollar-yen. But there is one wrinkle, which is that after the 4-hour candle shows the 5 simple moving average crossing below the 20 simple moving average, you don't just want to take the trade. You want to wait for a retrace back to the 5 SMA. Sometimes this retrace could be a big retrace, but oftentimes it's a shallow one. Before we look at the charts, let's talk about the stops and targets. The entry for day trades and swing trades would be the same, but the trade management would be different. For day traders, the setup is straightforward. Use a 30 pip stop loss and a 30 pip target for a 1-to-1 risk reward. That's what I suggest. This approach keeps your trade simple and easy to manage, allowing you to capitalize on the precisely small moves efficiently. Swing traders, on the other hand, can use the same initial parameters but with a twist. When the trade moves in your favor, take profit on half of the position at 30 pips, then move your stop to break even to neutralize the risk on the remainder of the position. Then, trail your stop loss by 30 pips to see if you can capture bigger moves while also protecting your profits. This method allows you to maximize gains while minimizing risk. Now back to the euro-dollar chart here. You never got the opportunity to sell on a retrace to the moving average, so it wasn't a valid trade. However, taking a look at the same chart, 7 out of the last 7 trades were winners. Here's the examples. Okay, let's start by adding the moving averages onto the charts. So we start by adding the 2 SMA, simple moving average. We're going to add 2 of them. The first one will be the 5 simple moving average, which we will leave as blue. And then the second one, we're going to change to the 50 simple moving average. And we will change that color to black just for ease of contrast. This is the first euro-dollar trade that we mentioned earlier. And this is not about a valid trade because it dropped significantly before it retraced, and it's just, this is far too long on a 4-hour time frame basis. Here, however, we do have a valid trade. The setup where for the 5 crosses above the 50 happens here. And then we go along the next candle pretty much at 108.45 plus 30 pips is 108.75. So we're exiting first half the position here and the second half somewhere over there. Here is the next trade. Here we have on this candle, the moving average, the 5 SMA crossing below the 50. And then we're going to short at 108.39, which is where the 5 SMA is the next candle. And you can see this low is 107.88, so 30 pips easily hit as well. Here we have the cross right over here, so we're going long at 108.56, and this one is another winning trade, so 3 out of 3 so far. Here is when we get the cross, and we don't actually enter the trade till over here, but unfortunately, I believe that this one is going to be stopped out. It's 108.30 entry, and it just stops us out pretty much by a pip. But it never really went to target anyway. So 3 out of 4 winners. Here in Eurodollar, we get the cross and this candle over here. Let's move this upwards. We get the cross at this candle over here. We wait for the retrace to the moving average at 107.03. So our stop is at 106.73. That is nowhere near there. And then it powers higher. And this one you can see becomes a very, very powerful move, more than 100 pips. Some of them are one-to-one trades. Some of them can be much more generous trades. So that's basically 4 out of 5. And here's another example where we get the crossover right here. We go long here at 106.71. And this also becomes another powerful move, 5 out of 6. And let's see. And this one, we had to wait a little while, but not too long. We get the retrace over here at 107.49, and this becomes another really nice, smooth swing trade. So basically 6 out of 7 winning trades in the Eurodollar using this 4-hour chart setup. And, those are the kind of odds that I like to see. No one is going to be able to share a strategy that's 100% accurate. If they show you that and tell you that is 100% guaranteed, then, they're lying to you. Every strategy will win and it will fail. It's a matter of finding strategies that have the high accuracy, high win rate as much as possible. And these are the odds that I like. So now let's take a look at it in the NASDAQ. In the NASDAQ, let's go back to current. You can see here is a really beautiful setup. We get the crossover right over here. You're going long right over here probably at this moving average when it touches back. And boom. Really solid move. You would have gotten the first target and definitely some really nice trailing stops there. Over here, we get the cross down right over here. And we get the retrace right over here. And once again, very beautiful move lower. Obviously, with NASDAQ, you have to use different risk reward. It's not going to be 30 points. You're going to have to figure out your own risk management. But you can see this becomes a very nice move lower. And then over here, we have also a cross above over here. And then your entry when it retraces is going to be over here. And another very, very strong up move. But there will be losers, just like you see here. Here, you would have gone short, and this was a losing trade. But that's why it's so important to squeeze more out of the NASDAQ trades, because when you catch a really nice, strong momentum move, it can be a very, very powerful one. And then over here, we're going long right here. And this also becomes a nice but shallow move. So we got 4 out of 5 winners here. And then here, it's hard to tell depending upon how conservative or aggressive you are. Maybe you would have gotten some pips, maybe not. Here, we have you enter probably over here. Very, very nice, strong trend move over there. And then you probably would have lost money here. But as you can see, it kind of flames out quite early. So you're going long over here. The losses are small compared to the big move over here. And so that's basically the type of odds that we want to see. And it works quite effectively in the NASDAQ as well as in the Eurodollar. But of course, avoid weekends, avoid holidays, and stick to the active, market hours and not before like FOMC, for example, where some of the signals could be really false signals. Here's another tip. Incorporating fundamental analysis can significantly enhance the quality of your trades. By making sure you only take the trades that are in line with the fundamental story, you increase your chance of success. I personally love to use this strategy in conjunction with my tried and true ZIP trading strategy. If you're not familiar with my ZIP strategy, here's how it works. If the currency pair is trading above the indicator line, and this is a trading view chart, as you can see here, and the background is green, it is in the buy zone. If the currency pair is trading below the indicator line that in the background is red, it is in the sell zone. So you want to buy in the buy zone, sell in the sell zone. And if the candle turns white, that's a buy or sell signal. Of course, you don't want to take these trades blindly. I only take the trades that are in the active market hours and the ones that are aligned with fundamentals. Now, with the 4-hour trading setup, if I see the 5 SMA and the 50 SMA crossing while the currency pair is in the zip buy or sell zone, that is consistent with the cross, it makes this trade even more attractive. Alternatively, if a zip buy or sell signal triggers and the cross happens later, it is still a powerful trade signal. So combining my zip strategy with this 4-hour trading setup has helped me bank pips 12 out of the last 12 months. Of course, past performance is not indicative of future results. If you want to learn more about my zip strategy, please see the links in the description below. So there you have it, a simple yet effective 4-hour chart trading strategy using the 5 SMA and the 50 SMA for trading Eurodollar, Pound Dollar, Dollar Yen, and Q. Whether you're day trading or swing trading, this approach can help you capture market moves with higher accuracy. Now, if you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more trading strategy and tips. Happy trading, thanks for watching, and I'll see you in the next video.